What is up, YouTube? It is your favorite jacked and tan investor. And today I'm going to show you how I made almost $60,000 in a little under a year. And I'm going to walk you through how my strategy has now transformed into a high yield, income generating growth machine. So without further ado, let's get into it. All right, we're jumping right into the portfolio here. Don't want to waste your time. I want to show you the goods. Okay. So as you can see right now, this is my real portfolio, my real money. Welcome, Tanner. Okay. Right now, the portfolio is up to about 63,000. You've got your different allocations here, which we'll walk through. But before we get into that, I kind of want to give you just a really high level, quick overview of how my portfolio is structured and how it's creating income and high yield dividend distributions. So essentially what I've done is I have three different buckets in my account. I have the largest allocations set up in closed-end funds, specifically the Cornerstone Funds, and I'll get into what those are and what they do here in just a second. But then I also have a grouping of high-yield dividend-paying ETFs that pay, most of them are weekly pairs, and they are very high yield. They're anywhere from 20% to 80% on the yield. And actually, one of them is even actually over 100%, which is crazy. We'll get into that too. And then the third bucket or third section of my portfolio is just shares of stocks and companies that I like, that I believe are going to have long-term upward trajectory. And I'm just selling my own options on them. I'm selling my own calls on those shares that I own. And the grouping of those three different strategies pay, high yield dividends or create income and essentially pay down margin, because I am using this brokerage account to live out of, meaning that all of my bills, all of my W-2 income is coming into this portfolio and all of my bills are being paid out of this portfolio. So it's essential that it generates like a business. And so I will show you what that looks like here momentarily. So now that's the high level overview. The one of the main components of this system is, since I'm using margin to pay my bills, I have to be careful about which funds that I select. Okay. You can't have high margin maintenance funds, or too many of them, I should say, in your portfolio, because that will eat into your equity. And the equity is what you are using to pay your bills and live out of your brokerage. Now, if you don't know what margin maintenance is, okay, you might want to do your own research. And again, none of this is financial advice. This is, I'm not a financial advisor. This is just what I'm doing. And I'm just sharing this for education purposes. But do some research on margin maintenance. Essentially what it is your brokerage will allow you to borrow against your own money, your equity in your account. So let's say you have $10,000 in your account, your broker will let you borrow $10,000, and that gives you a total of $20,000 in purchasing power. Now, the trick to that is different funds have different margin maintenance requirements. For example, I shared that the Cornerstone Funds are my biggest holding, and the reason why is because not only are they low volatility, but they also have a small margin maintenance requirement. They are only a 30% margin maintenance requirement, meaning that I only have to, they only set aside 30% of my total equity to hold as collateral against that position. So I hope that makes sense. Again, if you need to do some research on margin and how it works, please do so, because this system will not work if you don't understand what margin is. Now, again, speaking of margin, if you look at this section here, it'll tell you what I have available for withdrawal in cash, what I have available for withdrawal in cash plus margin, and then what my margin purchasing power is. Now, again, you don't want to use all your margin purchasing power. That is irresponsible, because if you are over leveraged in margin and the market has a downturn and that eats into your equity, that eats into the performance of your portfolio, you will have what's called a margin call. Okay, and you don't want that. It's bad news. Basically, you have to sell your shares at usually a loss, because the market obviously is down, and you have to use the income from you have to use the equity from those shares that you sold to pay off the margin debt, right? The margin leverage. So again, you don't want to be over allocated. You never want to use more, even on the extreme end. You never want to use more than 50% of your margin equity. I try not to use more than 30 or 40% to leave myself a large buffer for downturns, because when that happens, and it happens, right? That's just a reality of the market. Those are buying opportunities, and you want to be able to buy the dip when those red days happen. And if you're over leveraged, you're not going to be able to. And then this whole system kind of falls apart. Okay, so let's come into the portfolio and let's take a look at what we are working with here, because I want to show you my positions, my holdings, why I chose what I chose, and how they help my portfolio perform in an up market or a down market. So if you look at my days gain unrealized, I'm sitting at a 0.83%. Now, the market today was up, the NASDAQ was up about 0.59, 0.6%, so beating the market, okay? Now, you'll also see here that these are all my different positions, all listed out. I'm going to go through all these and kind of explain what they do and why I have them, and how they're assisting in the strategy. So CLM, CRF, these are my two largest holdings. I have about a $6,000 position in both of those for a total of about $12,000. They're about 20% total of my portfolio right now. I'm trying to get them to be about 40%. That's a really good anchored position with a high quality fund that smooths volatility, pays a great dividend. The Cornerstone Funds are closed end, which means that they have essentially special benefits for shareholders. So one of them is you get about a 20% dividend every month. You also can reinvest that dividend at the net asset value for another 20% upside every month. Basically what that means is, especially with E-Trade, if you have an E-Trade account, they allow you to have that corporate sponsored reinvestment where you get that 20% upside, because you can see right now they are trading at CLM's trading at $8.27. CRF is trading at $7.96, but the net asset value is probably closer to $7 a share for both of these funds. So every month when your dividend gets reinvested, you're getting that upside because it's dripping at the lows for you. So it's just amazing benefit of that fund. So that's why it's the bigger part, the anchor, if you will, of my portfolio. Now, if you move down into some of these other holdings, I have Chippy here. This is a really great high yield dividend ETF that was created by Yield Max. It's one of their products, and it's been performing amazing. It's one of the better performing high yield dividend ETFs currently out. I mean, you can see here my total gain, is up 3% on this position. It's a newer position too, and total gain of $144 since I opened it, and it pays about a 40% yield. Pays about a 40% yield annually. Pays a great dividend every week. It's a weekly pair. Then you got HOYY. This is the only high yield dividend ETF that I have Granite shares. And so far, I like it. It's not my best performer, but it pays a crazy yield. It pays over 100% yield. But it's also newer from them and to my portfolio. So we'll see how it performs over time. Then I've got KYLD. This is a new one by Curve. This is a high yielder that is. So this KYLD, this is a new one by Curve. So far, I really like it. It's holding up well, even with the volatility we've had the last couple of weeks. It's paying a really nice, steady, consistent dividend, about 16.5 cents per share, which is really good. I mean, it's a weekly pair, right? So you take that 16.5 cents and you times it by 4, and that's what you're getting per share per month. It's pretty great. OARC, I really love this one. This is a high yield dividend ETF, also a Yield Max product that tracks the ARC investment fund, Kathy Wood's fund, and it's performed really well. Pays a great dividend. I really like it. I plan on holding it for a really long time. So SARC, this is actually a inverse ETF, which means that it does exactly the opposite of what OARC does. So when OARC it has a green day, SARC moves down. It's a hedge essentially. This is one of the things I do in my portfolio to help smooth out the volatility on red days and outperform the market, because and that's why it's such a small allocation. I have about $6,000 in OARC, but I have about $1,000 in SARC, and that helps me not lose a lot of money on a green day when OARC is doing well like today, but it also helps me minimize the downside on a red day when OARC's not doing as well. And then you have Salty. This is an inverse ETF that YieldMax has that has a more bearish bias. So they are generating options income off of stocks that they feel have more downward momentum. But it acts as a hedge, especially on red days. It'll generally be green and kind of help offset volatility in the account. And then I've got SoFi. I love SoFi as a company. I think they're going to do amazing things. I've been trading this stock for the last year. I remember back when the stock was $12 a share. Now it's up to almost 30. It's been as high as I think 32, 34, 36, somewhere right around there. So there's still lots of upside. It'll retest that upside, as the market continues to move higher. And below that, I'm actually selling a call. So this is again what I described earlier in the beginning is I'm essentially buying stocks that I like and selling calls to create more income. So I'm getting growth and I'm getting premium because I just roll these every week. I'm a really big fan of selling in the money calls, and I'll get into that in another video. But essentially, it just offers me a lot of downside protection, especially when the market's volatile like it's been the last couple of weeks. And it allows me to generate income off shares that I already own. So it's great. SPXU, this is a inverse ETF on the S&P 500. Again, very small position. As you can see here, it's only $800, but again, it helps me outperform the market on a red day. SQQ, this is a inverse of the NASDAQ 100. So again, same idea. As you can see here, only about $800 position. It's just a small hedge. This way I don't lose a lot of money on green days, but it helps protect the downside on a red day. Because if you're living out of your brokerage account and you're using margin, you wanna maintain and protect the equity the best that you can. TQQQ, this one is great. This is a triple leveraged ETF on the NASDAQ 100. They recently did a forward split and made this stock price a lot more affordable. So I bought 100 shares. So as you can see here, it's almost a 10% position in my portfolio, but it goes hard on green days. I mean, as you can see here, I'm up almost $1,000 in the position since I started. I started that position last week when the market was down. That's one of the secrets. You buy when the market's down. And then I waited for the stock to rally, and then I sold a call. Because again, this is generating premium, but it's also going to help protect downside on a red day or on any kind of a pullback that could happen. Then you have Ulti. This is a very popular high yield dividend ETF. It gets a lot of hate. I love it because it's got like an 80% yield. They just did a forward split on this one as well, reverse split on this one. Reverse splits. If you had 100 shares, it turned into 10 shares. That's it. So they just made the NAV price, if you will, go up so that it could maintain its low margin equity requirements. But it's still a very high yield dividend paying ETF. I like it. It's just a vehicle for me to pay down my margin. That's why I have it. Winter. This is an inverse on MSTR or Strategy. Strategy is a leverage play on Bitcoin, essentially. So I really like this one because this one hedges against the volatility of Bitcoin, especially lately. Lately, I mean, I don't know if you're into the market like me, you know that Bitcoin is down quite a bit right now. So it's actually been pretty green today. I mean, today Bitcoin bounced hard, like 6%. So that was cool to see. So this one is just to help hedge against the downside of Bitcoin, because a lot of these high yield dividend ETFs are high beta, which means that they move really aggressively. The volatility is aggressive compared to what the market would do. And so if you have something like Bitcoin that's highly volatile, move extremely hard like it has the last couple of weeks, then you're going to get a lot of movement in some of these other high yield dividend ETFs because they're high beta. That's how they create the premium. They sell options on high volatility stocks. And volatility basically just means the rate at which the price moves up and down. You think about it like bouncing around. The faster the price bounces around, the higher the volatility is. But that's also what creates option selling premium. So it's part of the game. I don't really worry too much about it. Maybe earlier on in trading, it really stressed me out, but now I learned to just accept it. I love it. It's good. It's healthy. It creates a lot of income. So you just got to think about it that way and not be emotional. WPay. This is a round hill leverage ETF that I really like. Again, it's about a 10%. Now, as you can see, some of these positions are green, some of them are red, and that's totally okay. I have them structured and sized according to scale in my portfolio. These funds all have a job. Some of those jobs are not the same. These high yield dividend ETFs, they pay down my margin. They are vehicles to pay down margins. So they tend to on a chart not look like they perform very well because they're paying such high distributions every week. But if you look at total returns, they're all, pretty green, especially this year with how the market's been. Um, so again, it's something to keep in mind. These all have different jobs. These single stocks that I hold, I'm selling calls against. They're my growth engines. I'm going to keep adding more shares of more companies that I like over time, selling calls, creating premium. This one I actually bought today, BitX. So I had mentioned Bitcoin has been down, so buying opportunity. I bought 100 shares of this. It's a 2x leverage ETF on the price movement of Bitcoin. And I waited for it to rally today, and it did. It rallied, as you can see, it rallied almost 13% today because it's a double leverage ETF. And then when it started to show some slowdown in momentum, I sold a call on it to hedge the downside and to create premium. So again, the whole structure of my portfolio is based upon option selling. If it's not a high yield dividend ETF that is actively managed and sells options to create premium, then it's shares that I own that I like on companies that I like that I intend to hold for a long time that I'm selling calls on to create premium. And again, they're all anchored by the biggest allocation of my portfolio, which is the Cornerstone Funds. So this is currently how I have my portfolio structured. I intend to keep it like this for quite some time because it's been performing so well for me. Like I said, on a green day, I outperform the market. Even if it's not by a crazy amount, it's still outperforming the market. And on a down day, it's not falling as hard as the market. So real quick, just to end the video here, I want to show you the bigger portion of this. So if you come into here, and these dividends are actually not 100% accurate right now because they've done some forward splits, some reverse splits on a lot of these funds that I hold. So I'm actually missing some of these in here right now. So you can't see ULTI in here, you can't see OARC. Some of the higher pairs I'm actually missing right now. But even let's say that wasn't the case. $17,000 a year in dividends is nothing to scoff at. So right now I'm making about $2,000 a month in dividends. And again, that is paying off the margin that I'm using from paying my bills. And then the option premium income that I'm making is also doing the same thing and helping me compound faster. So essentially the whole idea in this is that you have accelerated compounding that allows you to retire sooner and live more freely and not be saddled by debt and high interest that most of our society is built off of. Margin is great because one, unlike a credit card, when you pay down your margin, you own the equity. A credit card, you basically just pay off the credit they've given you. And, unless you're getting a credit increase with them, you're not getting more borrowing power. You're not getting more purchasing power with margin. Every time you put $1 into your margin account, if you have day trader status and you have over 25,000 in your margin account, you're getting 4 times margin purchasing power. So every dollar gives you basically 4x, right? That dollar can work 4 times harder. And so I'm borrowing money to advance my own position in life. I'm doing basically what a business does. I'm borrowing money to buy assets and generate income to pay off that debt and continue to generate revenue. So that's all that this is doing. It's a business spread essentially with my own personal finances. But I hope this has been beneficial. I hope you've learned something. I'm trying really hard to make it simple. I'm sorry if it's still confusing. Please drop comments, questions. I will gladly answer them all individually and give you the time and attention that you need to learn this and to really catch on to it. But please share, subscribe, comment, join this journey with me. Let's do it together. I hope you all have an amazing day. Thank you for watching.